Being joined by the top management, Ramani Dathi, the Chief Financial Officer at TeamLease Services, now live with us. Good morning. Today we are seeing the market sell off, and we've seen the stock also come under pressure. The market's perhaps disappointed, not just about maybe the numbers missing their estimates, but is it to do more, you think, with the commentary of what we've seen in the last couple of weeks as well? More layoffs that are taking place in the startup world. I think nearly 25,000 since this year has started. In the tech world as well, as earnings have been coming in the IT services companies, headcounts are also not going up. Give us a little bit going forward. When are you going to bounce back?
Yes. So let me cover segment wise. So in general staffing business, for the months of October and November, we have seen decent demand. And we thought the same kind of hiring trend will continue into December, because if we take our prior trends in the past years, so Q3 contributes to our highest headcount in terms of growth. And the layoffs or attrition will start picking up maybe end of Jan or mid of Feb. But this time we have seen a very weak festive demand by mid of November, and the layoffs have started by end of November. So December, we didn't have much growth in terms of headcount in general staffing. And this is something which is a surprise to us, because in terms of festive hiring, this is the weakest we had in years. So that's on general staffing front. Coming to IT, as you rightly pointed out, overall, there is a hiring freeze. On top of that, typically for the months of November and December, many companies apply furloughs and lower billing for the resources who are on consultant roles. So that also has impacted us. And as of now, we are not seeing any pickup even for Q4 in terms of IT staffing. So we are seeing some momentum in terms of consolidation of numbers across vendors, but the new hirings, we are yet to kind of get an initial hint of it. And the other business, which is again a surprise to us, is our degree apprenticeship business. On 3rd of Jan, so we received a notification that the NEEM program, under which we have 26,000 trainees, so that the government is withdrawing the program, and we may have to release these apprentices in the coming quarters. And as of December, we already released 20,000 trainees, so that also has impacted our quarterly performance, both in terms of growth as well as profitability.
But Ramani, if you would allow me to so rudely interject there, I take how the segmental wise the businesses have done, but is there any large message from TeamLease to the markets that, given the uncertainty that we are seeing in the larger world of staffing and employment, which is of course being seen by all of us, when you're expecting a turnaround, like should they, for example, be used to your margins now being around 1.4%? Should they be used to maybe revenues staying flattish, if not seeing a downtick for the second half of the financial year, maybe even the first few quarters of the new financial year?
Yes. See, in terms of top line growth, our revenue growth, even for the current year, we will maintain a 20% growth because we already have the pipeline for that to get to those estimates. Even for next year, even if the current kind of softer outlook continues, so we can maintain a 20% growth. But the problem is in terms of margin expansion, because for us, the main margin contributors are IT staffing. So there we have close to 8 to 9% of net margins, and the degree apprenticeship business. So with these two businesses going under pressure, so we may not have any improvement in our overall margins for the next few quarters. Otherwise, in terms of top line growth, as I mentioned, 20% can be maintained. Headcount growth, 15 to 18% can be maintained for next year as well.
Good to know that you're maintaining your revenue growth at about 20%, but just wanted to ask as well about the share buyback. I understand that that's being considered next week. What exactly is the rationale for this?
So, I can't disclose details because the meeting is yet to happen. But the fact that we didn't do any M&A acquisition for the last 3 years, and currently we don't have any other alternative investment opportunities, board wants to revisit this discussion in terms of capital planning and allocation, how we should think about it. And that's the main agenda for the 3rd Feb meeting.
Now, I understand that you were confident of that margin recovery timeline, and that had been extended by another 2 to 3 quarters, due to the NETAP accident. HR services, specialized staffing margins is at about 8 to 9%. So what is the outlook now when it comes to your overall margin picture, and where can we see it settle at, given that you're confident about your revenue targets?
Yeah. So the current 1.4% margins will continue plus minus maybe 5-10 basis points for next 1 or 2 quarters, and only by second half of next year, so we can demonstrate improvement in margins, because that's when we believe the recovery in IT will start picking up, and also we'll get more clarity in terms of transitioning of the NetApp trainees into other programs, or either converting them into staffing options. So for next 2 quarters, we may continue at the current margin levels.
Ramani, great to have you today on ET Now. Thank you so much for taking the time out and speaking with us.
Thank you.